Hey there, future investors. Welcome back to the channel. If you've ever found yourself Googling how to make money without doing a ton of work, then congratulations, my friend. Today is your day. We're talking about index funds, the lazy investor's ticket to building wealth without having to pick individual stocks. Watch CNBC all day, or even memorize the stock market jargon. Yep, you heard that right. No complicated formulas, no anxiety-inducing decisions. It's all about simplicity and consistency, so buckle up. By the end of this video, you'll know exactly how to get started with index funds and why they might just be the best investment you'll ever make. Let's dive in. First things first, what in the world is an index fund? Don't worry, we're not about to dive into the deep end of finance lingo, promise. Think of an index fund as a basket of stocks that automatically tracks a particular market index, like the S&P 500, the Nasdaq, or the Dow Jones Industrial Average. Picture this. If you were to invest in an index fund that tracks the S&P 500, you would own a small piece of 500 of the biggest companies in the US. So instead of buying individual stocks like Apple, Microsoft, or Tesla, you're buying a little slice of them all, bundled together in one neat package. Cool, right? Now, why does this matter? Well, in a nutshell, index funds let you invest in the entire market without having to pick individual winners or losers. Think of it like trying to predict the winner of a football game. Instead of betting on one player, you bet on the whole team. Spoiler alert, teams tend to do better than individual players over time. So you might be asking, why should I invest in index funds? They sound too easy. And you know what? That's kind of the point. Here's why index funds are the best kept secret for most investors. Low cost. You know what's better than paying a ton of fees? Paying none. Well, not literally none, but index funds typically have some of the lowest fees compared to actively managed funds. That's because instead of a fund manager picking and choosing stocks, the index fund just tracks the market. So, you're not paying someone to make decisions, you're just along for the ride. Sounds like a win, right? Diversification. With index funds, you're spreading your risk. Instead of putting all your eggs in one basket, hello Apple stock, you're diversifying across multiple stocks. That way, if one company falls, it won't hurt as much because you have plenty of other companies in the fund holding their own. It's like assembling a dream team. Just imagine the S&P 500 as your squad, and you're the coach. Simplicity. Remember when I said this was the lazy investor's dream? You don't have to spend hours researching stocks or listening to podcasts with confusing jargon. With index funds, you set it and forget it. It's one of the easiest ways to invest and still earn solid returns in the long run. All you have to do is contribute, and the fund does the rest. Consistent performance. Over time, index funds tend to outperform most actively managed funds. Studies have shown that most fund managers fail to beat the market in the long run, which means you're better off investing in something that just tracks the market rather than hoping a fund manager will pick the next big stock. It's a steady Eddie approach to investing. All right, so now you're thinking, okay, this sounds amazing, but how do I pick the right index fund? Good question. There are so many options out there, it can be overwhelming. Don't worry, I've got your back. Here's a quick guide on how to choose. Determine your goals. Are you looking for growth, or are you just trying to preserve your money? If you want growth, look for index funds that track growth-heavy markets like the S&P 500. If you're more conservative, you could go for a broader index, like the total stock market index, which includes both large and small companies. Understand the index you're tracking. Before you jump in, make sure you understand what the index fund is tracking. S&P 500, that's 500 of the largest companies. Nasdaq 100, tech-heavy. Dow Jones, those 30 industrial companies are what you get. Do your research on the index so you're not surprised when your portfolio is filled with tech stocks, if that's not your jam. Pay attention to fees. I know. Fees sound boring, but trust me, low fees equals more money in your pocket. Look at the expense ratio of the fund. The lower the ratio, the better. Ideally, you want that number to be under 0.1%, but even if it's slightly higher, make sure you're getting good value for your money. Diversify. While index funds are already diversified by nature, it's still a good idea to make sure your overall portfolio is balanced. Maybe mix it up with international stocks or bond index funds. A well-rounded portfolio helps weather market swings. Now that you know why and which index fund to choose, let's talk about how to start investing in them. Ready? Here's how to jump in with ease. Open a brokerage account. To buy index funds, you'll need a brokerage account. There are so many platforms out there, from Fidelity to Vanguard to Charles Schwab. Just find a platform that feels comfortable, has low fees, and offers index funds that match your goals. Decide how much you want to invest. You don't need to be a millionaire to get started. Many index funds allow you to start with as little as $50 or $100. Start small if you need to. The important thing is that you start. Even $50 a month can add up over time. Set up automated contributions. The best part about index funds, you can set it up on autopilot. Automate your contributions so you don't have to think about it. It's like a gym membership for your money. Consistency is key. You'll be amazed at how quickly it adds up. Stay patient. The last and most important step, be patient. This isn't a get-rich-quick scheme. Index funds are about long-term growth. Just keep contributing and let time do the heavy lifting. Okay, let's get one thing straight. Index funds are awesome, but they're not risk-free. Sure, they track the market, but the market fluctuates. That means you could experience some ups and downs along the way. But remember, don't panic. The market historically has always trended upward in the long run. The trick is to stay invested. If you sell during a market dip, you could miss out on the recovery. Stay the course, trust the process, and keep contributing. And there you have it. Index funds are a fantastic, low-cost, and relatively simple way to grow your wealth. If you're looking for a steady, hands-off investment that doesn't require hours of research, this is for you. So take the first step, open that brokerage account, and start investing in index funds today. If you found this video helpful, please give it a thumbs up, subscribe, and share it with anyone who needs to hear about the magic of index funds. Don't keep this wealth-building secret to yourself. Share the love, and let's make this passive income party bigger. You never know who might need to hear it. Got questions or thoughts on index funds? Drop them in the comments below. I'd love to hear from you. Keep investing, stay patient, and I'll see you in the next one.